Hey everybody, this is Mitchell Shields speaking to you again here at Jeff Cates Math Logic Wealth class. Last week, Jeff asked me to speak about the first of the sweeteners when it comes to life insurance with corporate ownership, and today he's asked me to come back and speak to you about the Capital Dividend Account. So today I'm going to spend some time, about 5 minutes, talking about the 5 key things that I believe that advisors should be explaining to the consumers and to purchasers of life insurance when it comes to this Capital Dividend Account. So first and foremost, before we even get into the Capital Dividend Account, we need to understand what integration is. What is the concept of integration? And in theory, what this means is whether you earn income personally, so let's say you're a T4 employee and you earn $100,000, or if you have a corporation. So again, let's say you have a corporation, you earn $100,000 into that corporation, you pay corporate taxes, and then you pay yourself out a dividend of whatever is remaining. Integration in theory is designed to balance those scales. So regardless of whether it's through the corporation or personally, the end tax result should be the same. Now, with all of this integration in provincial and federal regulations and laws, there can be some elements of disconnect. And one of the areas where integration breaks a little bit in the favor of the consumer is when we think about corporate-owned life insurance. And this can happen because the death benefit of the policy, which I'm going to get into a little bit more detail in the next few slides, but the full death benefit of the policy minus the cost basis is added to your capital dividend account and come out tax-free. So regardless of whether you have the policy personally or corporately, you're going to be able to extract those funds on a tax-free basis. Now, within the corporation, though, you're paying the premiums for this life insurance policy using after-tax corporate dollars, which is at a much lower rate. We talked about this last week, so I would refer you to that session to go into this in a little bit more detail. But that is really a key benefit to where the integration can break a little bit in your favor. So the key consumer message there is the lower cost of fund, and there's a tax-free withdrawal. So the mechanism is there designed to maintain that tax-free benefit of life insurance. So what is this capital dividend account? So essentially, the capital dividend account is a notional account. So that means it's not money sitting in the bank account. It's a paper balance and it's tracked for tax purposes. And anytime you have non-taxable income for the most part, so the non-taxable portion of your capital gains, or the big one that we're talking about today would be a life insurance death benefit minus the policy's cost basis, is added to this notional account. Now, any capital losses will reduce it, which we'll talk about it later. So the CDA, in short for our consumer, is one of the only ways that we can extract money out of your corporation personally without paying any personal taxes. Now, this is a calculated at the time, essentially, calculation. So whenever we have capital gains and other elements that add to the CDA balance can go up. That said, things like capital losses, so let's say the company has a capital loss, that can reduce or grind down against your capital dividend account. So for my example here, let's say you had 500,000 of CDA credits available today that you can take out of the corporation on a tax-free basis. You have a $200,000 capital loss that will reduce your capital dividend account by $100,000. And this grind can happen before you paid the dividend out or even as you're going through the calculation. So the consumer message is market losses and other capital losses in the corporation can quietly erase part of your CDA. And that leads into my next element. This is not automatic. This is an important thing for consumers to understand. This capital dividend account does not automatically get rectified at the end of the year. There is a very specific form that you need to work with your accountant on to file for this CDA election. Now, this will come with cost with your accountant. They'll charge you some professional fees. And even if you don't have cash on hand, as I'll talk about in a little bit later, even if you don't have the money, you can still elect to do this capital dividend account payout and form it as a promissory note due to shareholder balance and pay it out later, but you lock in the credit. So filing these elections can protect your tax-free payout, and you don't have to wait for cash flow would be the key consumer message there. Now, timing the payout. I am of the camp that when you have a capital dividend account that warrants the fees, for the accountant to file the elections, you should be looking at paying out this capital dividend account, and you should be looking at this at an annual basis. So let's say a large credit is added, think of an insurance payout, large capital gains are accumulated over time. The corporation should look at paying this capital dividend account out, whether in cash or in form of a promissory note if the corporation still needs the cash for other business reasons. There are other corporate investments that can cause volatility risk, and you could potentially reduce that capital dividend account, or potentially maybe you're looking at winding up the corporation in the future and you should look at paying this out. So waiting too long has risks. The consumer message is the perfect time to pay it out is before the opportunity disappears, in my opinion. And I think the practical advice from most tax professionals would be to pay out these capital dividend balances whenever you can, again, even as a form of a promissory note in practice. So in summary, 1, the capital dividend account creates tax-free withdrawals from your corporation. 2, corporate-owned life insurance can break this integration slightly that we talked about by having lower taxed corporate dollars pay for the premiums of your life insurance. 3, capital losses reduce the CDA by the non-taxable portion of the loss, so you should look at filing it. And 4, you must elect to pay this out. It doesn't happen automatically. And review and pay your CDA dividends at the right time to protect the credit. So in closing, CDA is your ticket to tax-free corporate withdrawals. Protect it and use it wisely.